Revenue is the number founders love to show investors. It is also the number sophisticated investors trust the least until they understand where it comes from, how profitable it is, how much cash it produces, and whether it will still exist next year. A business can report $10 million in sales and still be a poor investment. Another business can be smaller, quieter, and far more valuable because its revenue is predictable, its customers stay, its margins are real, and its management team can explain every important driver of the business. So today, I am going to walk you through the 5 questions serious investors use before they invest capital. This is not a shortcut to funding. It is a framework to help you understand how professional capital separates a compelling story from a durable business. I am JM. For more than 30 years, I have worked in wealth management, investment analysis, and business strategy. I have watched investors review businesses that looked extraordinary from the outside and then discover that the economics, the cash flow, the customer relationships, or the operating systems could not support the story. I have also seen businesses that did not look exciting at first glance, but had the characteristics serious investors value most: durable revenue, disciplined operations, credible leadership, and a clear understanding of risk. Before we continue, this video is for educational purposes only. It is not legal, tax, accounting, valuation, or personal investment advice. Every business, industry, capital structure, and transaction is different. The point is not to give you a formula that guarantees an investment or a funding round. The point is to help you build a stronger company and speak the language of serious capital. Let us begin with the first question. The first question is not, how much revenue do you have? It is, what kind of revenue is it? Imagine 2 companies. Company A generates $5 million in annual sales. That sounds impressive, but every project is one-off. Every January, the sales team effectively starts again from zero. Customers negotiate heavily. Some projects are profitable, others are not. A few clients represent a large portion of total revenue, and the company does not know whether those relationships will still exist 12 months from now. Now imagine Company B. It generates $3 million in annual sales, less than Company A, but its customers sign annual contracts. Renewals are strong. Pricing is consistent. Revenue comes in monthly. No single client can destabilize the company. Management can estimate next quarter with a reasonable degree of confidence. Which business is easier to finance? Which one is easier to value? Which one gives an investor more confidence? The answer is usually Company B. This is the difference between revenue size and revenue quality. Serious investors look at recurring revenue. They want to understand how much of next year's revenue is already visible through subscriptions, contracts, maintenance agreements, repeat purchases, framework agreements, or reliable customer behavior. They look at contract duration. A 12-month agreement is not the same as a 3-year agreement. Neither is automatically better in every industry, but duration can tell you how much revenue visibility the business has. They examine retention. Do customers stay? Do they renew? Do they buy more over time? Retention is evidence that the company delivers genuine value. They look at churn. How many customers leave and why? Is churn concentrated in one segment? Does it happen after a price increase, a poor onboarding process, weak service, or because a competitor has a better offering? They test customer concentration. If one client represents a significant part of the revenue base, an investor needs to understand the relationship. Is the contract durable? Is the customer financially healthy? Does the founder personally own the relationship? What happens if the client decides to renegotiate or leave? And they examine pricing power. Can the company raise prices without immediately losing customers? Does the company provide something differentiated, mission-critical, scarce, regulated, convenient, or deeply embedded in the customer's workflow? Pricing power is often a sign of a strong value proposition. A serious investor does not dismiss large revenue, but they want to know how much of it is likely to reappear, how profitable it is, and how exposed it is to a small number of decisions outside the company's control. Revenue that is visible, repeatable, diversified, and defendable is usually more valuable than revenue that is simply large. The second question is, do the economics improve as the company grows? Growth is not automatically good. Growth magnifies what is already inside the business. If your customer acquisition process is efficient, growth can amplify attractive economics. If your margins are weak, your service delivery is expensive, or your pricing is wrong, growth can amplify the problem just as quickly. That is why investors look at gross margin. Gross margin asks a basic question. After you deliver the product or service, how much money remains before the company pays for the broader operating structure? The answer varies enormously by business model and industry. There is no universal perfect margin. What matters is whether the margin is stable, understandable, and improving or deteriorating for a clear reason. Then investors look at contribution margin. Contribution margin goes a step further. It asks what remains after the direct costs of winning and serving an incremental customer. In other words, does that customer contribute meaningfully? In other words, when you add one more customer, does that customer contribute meaningfully toward covering the rest of the company's costs, or do they create more complexity than profit? Next, investors examine the relationship between customer acquisition cost and customer lifetime value. How much does it cost to earn a customer? How long does that customer remain? How much margin does that customer generate? And how quickly does the company recover the cost of acquiring them? The goal is not to force every business into the same formula. Software, professional services, healthcare, they will have different models. The principle is the same. The company must understand whether it is spending intelligently to create profitable customer relationships. Then comes operating leverage. Operating leverage means that additional revenue may require proportionally less incremental cost. This can be powerful, but it can also work in reverse. If the company has large fixed costs and revenue slows, those costs do not disappear just because the sales forecast changes. This is why serious investors do not simply celebrate fast growth. They ask, are margins expanding or shrinking? Is the sales process becoming more efficient? Is the company acquiring better customers or simply buying revenue? Can the business scale without adding costs at the same rate as revenue? A founder who can answer these questions clearly is not just showing ambition. They are showing command of the business model. The third question is one of the most important and most misunderstood. Does revenue become cash? Profit and cash are not the same thing. A company can look profitable in a presentation and still be under severe financial pressure. Why? Because profit and cash are not the same thing. A company may win a large contract, recognize revenue, and report a profit. But before the customer pays, the company may have to hire people, purchase inventory, pay suppliers, buy equipment, deliver the service, and cover fixed costs. If the customer pays 60 or 90 days later, the company may need substantial cash simply to support the growth it is celebrating. This is where accounts receivable matter. Accounts receivable are invoices that customers owe but have not yet paid. If receivables grow faster than cash collection, the business can become increasingly dependent on external capital. For inventory-based companies, inventory matters too. A warehouse full of products can mask a weak cash position if they do not sell quickly. Then there is deferred revenue. Customers pay before delivery. That creates favorable dynamics, but a future obligation. Finally, investors review payment terms. How quickly do customers pay? How quickly must the company pay suppliers? Does management have a clear view of its weekly and monthly cash needs? The central question is this: how much cash does it take to generate the next dollar of revenue? If a business must continually inject large amounts of capital to grow, that does not automatically make it a bad business. Many high-growth companies require investment, but the founder must understand the financing need and show how the model can eventually generate sustainable cash flow. A serious investor will not be impressed by growth if that growth constantly creates a larger cash hole. They want to understand cash conversion, working capital, debt, capital expenditures, and the downside plan. A business that understands cash has options. A business that ignores cash eventually runs out of them. The fourth question is about management depth and operating systems. Investors do not expect founders to be unnecessary. A great founder is often a huge asset, but they do worry when the founder is the only person who can sell, price, hire, approve, negotiate, and maintain relationships. That creates key person risk. If the company cannot operate when the founder is unavailable, the investor is not buying a scalable organization. They are buying a person with a demanding job. So serious investors evaluate the leadership bench. Who leads sales? Who leads operations? Who owns finance? Who can take responsibility when the company becomes larger and more complex? They also evaluate the company's operating rhythm. Does management close its financials reliably each month? Does it have a dashboard? Does it track the key performance indicators that actually drive the business? Are problems surfaced early? They look at processes. Is the sales process documented? Is customer onboarding repeatable? Are pricing decisions consistent? Is intellectual property protected? Can a new employee learn without relying entirely on the founder's memory? And they look at governance. Governance is not just a boardroom term. It means there are clear decision rights, reliable reporting, appropriate controls, and a structure for holding management accountable. The strongest founders do not see delegation as losing control. They see it as creating capacity. When you build a capable team and repeatable systems, you free yourself to focus on the decisions that only a founder can make. Strategy, culture, critical relationships, capital allocation, and the next stage of growth. That is how a business becomes more investable. The fifth question is about risk, competitive advantage, and the growth plan. Every business has risk. The issue is not whether risk exists. The issue is whether management understands it. The issue is whether management understands it, measures it, and has a credible plan to manage it. First, investors assess the competitive landscape. What stops a larger competitor from entering the market? What prevents customers from switching? Does the company have proprietary technology, a trusted brand, a distribution advantage, regulatory expertise, specialized talent, customer relationships, or a lower-cost operating model? A moat does not have to be dramatic. It simply has to be real. Second, they revisit customer concentration. If a small number of clients represent too much revenue, the business needs a plan to diversify its base or prove durability. Third, they consider regulatory exposure. Is regulation central to the business? Demonstrate that you understand it. Fourth, investors analyze supplier dependence. If one supplier controls a critical input, the business may be vulnerable. What alternatives exist? Finally, investors test the growth plan. A credible plan is not, the market is huge, so we will triple. A credible plan says, here is the customer segment we will pursue. Here is the distribution channel. Here is the capital required. Here are the people we need. Here are the milestones we will use to measure success. Here are the risks, and here is how we will respond if the plan does not perform as expected. This is one of the biggest differences between a promotional pitch and an investable strategy. A weak pitch pretends there are no problems. A strong founder can explain the risks before the investor finds them and can show the systems, decisions, and contingency plans that make those risks manageable. Let us bring it together. Serious investors do not invest in a pitch deck alone. They evaluate whether revenue is repeatable and durable. They evaluate whether margins and unit economics improve with scale. They evaluate whether profit becomes cash. They evaluate whether the company can operate beyond the founder. And they evaluate whether management understands the risks and has a credible plan to grow. That is the standard. If you are a founder, do not wait for an investor meeting to begin thinking this way. Build your business so that the data supports the story, because the strongest businesses do not need to hide behind an impressive revenue number. They can explain the quality, the economics, the cash, the team, and the risk behind every dollar. To learn the institutional frameworks behind business analysis and wealth protection, visit a venture capital. Visit a venture capital through the link in the description. Subscribe to Be Rich Formulas for more practical institutional level thinking on building, analyzing, and protecting wealth. Stability today, upside tomorrow. Build the business, prove the economics, and manage the risk.